Should you trade options before earnings announcements? Have you ever wondered if trading options right before a company's earnings announcement is a smart move? This question is important for anyone looking to navigate the world of options trading. Let's break down the key aspects of this strategy. Trading options before earnings announcements can be a high-risk, high-reward approach. It involves purchasing options contracts, like calls or puts, in anticipation of a significant price change in the underlying stock after the earnings report. Traders often use this strategy when they expect a strong market reaction, whether positive or negative, to the earnings results. First, let's clarify what options are. Options give you the right, but not the obligation, to buy or sell a stock at a specific price, known as the strike price, before a certain date, called the expiration date. There are two main types of options: calls, which allow you to buy, and puts, which allow you to sell. Earnings announcements are events where companies share their financial performance. These announcements can lead to major fluctuations in stock prices, depending on whether the results meet, exceed, or fall short of what investors expected. One important factor to consider is implied volatility. This measures the market's expectation of future price movements. Typically, implied volatility rises before earnings announcements due to uncertainty, which leads to higher option premiums. This means you might pay more for options as the announcement date approaches. Now let's look at the pros and cons of trading options before earnings. On the positive side, if the stock moves significantly in the direction you anticipated, the returns can be substantial. This creates a great opportunity for speculation, as earnings announcements provide a clear event to bet on. However, there are downsides. If the stock does not move as you expected, or if the movement isn't enough to cover the premium you paid, you could lose your entire investment. Additionally, due to increased implied volatility, options can be more expensive before earnings, affecting the risk-reward balance. For practical applications, traders can make directional bets by buying calls if they expect the stock to rise or puts if they expect it to fall. This requires strong conviction in the direction of the stock's movement. Managing risk is essential. Many traders use strategies like spreads or hedging to limit potential losses while still allowing for profits if the stock moves as anticipated. Understanding and managing implied volatility is also key. Monitoring implied volatility levels can help you avoid overpaying for options or missing out on potential gains. In summary, trading options before earnings announcements can be a valuable strategy for those comfortable with the risks involved. Conducting thorough research, assessing market conditions, and managing risk effectively are essential to navigating these trades successfully.